YieldMax has released several new ETFs since I first found out about them, and as new funds make their way to the market and as the data comes in on returns, it's always worth looking at our options. One of these new funds is a real problem. Over 100% yield, how could this go wrong? So naturally, I sold my Tesla and Coney positions and bought it instead. I'll tell you what my initial concerns for this ETF are, what you need to know about the YieldMax funds in general, I'll go over some of the newer ETFs, give you the data on the total returns of all 26 YieldMax funds, and I'll give you my reasoning for why I sold Coney and Tesla and why I bought this problem ETF instead at the end of the video. The thing about YieldMax is that it's right in the name, YieldMax. They have numerous ETFs with yields above 50%, some in the upper 90s like its peak David Beckham, and yes, even over 100%, which means theoretically, if you invested $1,000 into their new ETF and held it for 1 year, it would pay out $1,000, or 100% return on your investment in a year from just the yield. That doesn't count the value of the shares of the ETF you held, or the yield you get after the 1 year mark either. The whole situation is very appealing, and the problem is that it's a bit insane when you stop and think about it. It sounds too good to be true because there's no guarantee that a high yield translates to actually making money, and yields will change as a result of market conditions. In my experience, they usually go down. And honestly, a 100% ROI in a year for any investment is very fast, like sketchy fast. Ask your local landlords, business owners, entrepreneurs, and 6'5" trust fund finance pros. They'll probably give you some raised eyebrows when you tell them, I found an investment that gives me back all my money in a year, and from there it's a cash flow asset. I'm just saying, it kind of sounds like you're growing marijuana illegally. Please consult your state laws and a lawyer before starting a new business venture. So before we just go chase the yield of some shiny new object and YOLO a bunch of cash, we should be aware that we can benefit from these ETFs, but we can get burned as well. That's the risk we take, and insanely high yields tend to make smart investors do impulsive things, which typically doesn't work out because our imagination can get the better of us. So I'm not saying owning any of these ETFs is right or wrong, but the reasoning for why an investor owns one should be based in reality as opposed to unrealistic expectations or even worse, knee-jerk reactions to 100% yielding ETFs. Because I'm sure we all remember at one point early in our investing journey chasing a high-yield investment only to lose money because we didn't know what we were doing. At least that was my experience. Shout out to YieldMax, the only fund managers that can make a 20% yield look boring. But remember, these funds are just like any other investment in the sense that they carry the inherent risk of losing money. So please remember, this is not financial advice, and I'm not a financial advisor. I'm just the average retail investor who happens to have a YouTube channel that can draw a lot of really experienced and informed investors to it. So if I get something wrong, or if you want to expand on something and add to the context of this video, leave a comment. I want to know. YieldMax ETFs utilize a synthetic covered call strategy to generate such a high yield. In a typical covered call ETF, the holdings would be used to write options contracts, which lets the fund collect a premium. The downside is that there will be a cap to the upside potential. It's just how covered call options work. For YieldMax ETFs, they don't actually own the underlying stock, but rather another options position that mimics holding the stocks when used in combination with their call options. And there's treasury positions as well that serve as collateral and can provide some income. So if you're looking for underlying stock exposure in these ETFs, this isn't for you. What you're really buying is the options trading strategy as it applies to a particular stock, which means that the options trading strategy is one thing to consider. So if you don't like the strategy, don't buy the fund. And if you're okay with it, then we need to consider performance of the stock itself. And since most YieldMax ETFs to date benefit from a single stock going up in value as opposed to down, you're going to want to be bullish on the stock the YieldMax ETF writes these options positions on. And remember, being bullish doesn't mean number go up. The market is going to do what the market is going to do, not what we want it to do. This setup applies to several of the YieldMax funds shown on your screen. With one of the newer ETFs, YBIT, or the YieldMax Bitcoin Option Income ETF, YieldMax also has fund of funds ETFs, where they take their own products and lump them together if investors want a basket approach, but be aware, only some of the covered call ETFs make it into YMAX, so be sure to check the holdings. And YMAG focuses on the Magnificent 7 covered call ETFs for investors looking for more concentration. But the new ETFs don't stop there. Of course, YieldMax has decided to give us an option to capitalize on Tesla's recent downturn too in the form of CRSH, and it works pretty similar to the covered call ETF, but it uses multiple options to set up what I'm calling a synthetic covered put, and features long out-of-the-money calls which serve to cap the potential losses. And it's nice to know that YieldMax has thought of this, so we as investors have options in up and down markets, and if markets make a turn for the downside in the future, they could roll out more of these types of funds as they see fit. The most interesting interesting of the new funds in my opinion is ULTY, which is the YieldMax Ultra Option Income Strategy ETF, and its goal is to generate monthly income from a portfolio of covered call strategies, each on a US-listed security. And a quick look at the holdings shows us that this ETF actually holds shares of stocks, unlike other YieldMax ETFs. For someone like me who wants high yield but doesn't necessarily want to manage options positions myself, this seems like a good investment option. And the fund gives the managers flexibility in the holdings and trading strategy, which is worth looking at to take advantage of volatility. In an interview with Bloomberg regarding UTLY, Jay Pestruccelli, CEO and co-founder of Zega Financial, which is listed as a sub-advisor for YieldMax, says it aims to find those stocks that have high volatility in their options. We get long the stock and then sell options 5 to 10% out of the money with short-dated options. It might be a week, it might be 2 weeks out, and the goal here is really to convert that volatility into option premium that then gets distributed on a monthly basis. But of course, the real test of any investment or any kind is total returns. Hey, real quick, if you're finding value in the video, be sure to click the like button so YouTube gives you more content like this in the future. And if you're still here with me watching this video, you probably enjoy money, finance, crypto, dividends, all the above, and we talk about that on this channel, so consider clicking the subscribe button too. Using Seeking Alpha's comparison graphs, we can see that out of the 26 YieldMax ETFs since their respective inception dates, 8 are sitting at a loss, and the other 22 are up overall. The highest performing ETFs were NVDY, CONY, and MSTY, which outperformed significantly compared to all the others. So why did I sell Coney, a top YieldMax ETF, and Tesla, which is based on Tesla, a stock I'm wildly bullish on, and buy UTLY, which is down about 4% since inception, looks like it has some price erosion to deal with, and has a dividend yield that I don't think is sustainable? Well, as I said in the beginning of the video, as time goes on, more data becomes available, and if a better option comes along, it's worth looking into. But of course, that's a little subjective because this is personal finance, to each their own. This is just how I feel about it. To be clear, Coney has had a good run, and I do believe Coinbase has more upside, especially if markets go risk on again, which I would think crypto and Coinbase will benefit from in the short term. And I also believe Coinbase is the go-to crypto exchange for the United States. And I'm still wildly bullish on Tesla for a lot of reasons, but mainly because I think my grandkids will live in a world where self-driving electric cars and even freight vehicles are a normal everyday thing. And that sounds right up Tesla's alley. The main reason why I sold is because I don't particularly love owning individual stocks at this point in my investing journey, and Coney and Tesla rely heavily on single stocks, and they're pretty volatile. Tesla is also dealing with some serious erosion that the yield doesn't seem to be combating well enough for me to justify the position, despite me being bullish long term, and despite reinvesting 100% of the dividends for a while. And total returns haven't been thrilling for Tesla since inception. I just have this strange feeling that as soon as I sell, this is when Tesla will start ripping to the upside, so it's going to be interesting how this move ages. CRSH is still based on a single stock, Tesla, which I'm trying to get away from, single stock exposure. YBIT is based on a Bitcoin ETF, and I already have enough exposure to crypto directly and would prefer something based on Bitcoin directly, given Bitcoin is ridiculously volatile. And YMAX and YMAG are combinations of multiple YieldMax funds, but that still feels limited in a sense compared to UTLY strategy. UTLY has more flexibility. For example, they were able to take advantage of the recent GameStop volatility, which isn't possible with any other YieldMax fund. For me, someone who wants to benefit from options income but doesn't necessarily want to manage the positions myself and doesn't have the experience necessary to make these trades, it seems like I would win in either scenario. It either works out for me or it doesn't. If it makes a return, that's fantastic and the overall goal was accomplished, and long term I can consider putting more into the fund, or maybe consider getting the education I need to try my own hand at options trading. If it doesn't work out, and even professionals who do this for a living with tons of experience, stock screening, and cash on hand have a hard time, well, that means I would most likely need to find another investment strategy. My backup plan is just SCHD and chill for now. So I'm okay with UTLY being down a bit in total returns. It's only been a few months since it's been out in the wild, and I'm okay with the yield coming down because I'm expecting it to, and there are other benefits that make sense for me as an individual. These positions in my portfolio are experimental at best, so I'm lowering my risk by only investing money that I'm willing to lose 100%, and there's an added benefit in that UTLY acts like an insurance policy against myself. The other day, I was tempted to jump into an options position in GameStop, and I probably would have lost money because I'm not good at trading options on my own. Thankfully, I recognized that I've already made that mistake before, and UTLY solves this problem for me because the position does those trades I would likely FOMO into. I can partake in the wild side of the market, not lift a finger, and wait for the results to show themselves in a relatively low risk risk way. So this is what works for me in this current moment, but of course my positions might change as time goes on and as new data comes in. Let me know your thoughts down below. Thanks for watching. See you in the next one.